Hello, and welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate professionals in tax. I'm your host, Tim LeMasters. Joining us today on Let's Talk Tax podcast is Dave McGuire. Dave is a shareholder at McGuire Sponsel, king in fixed assets and cost segregation. Dave, good to be here with you today.
Good to be here with you too, Tim.
I think a really good place to start today is let's just go back in time a little bit, where Dave McGuire started in depreciation. Obviously, you're an engineer by trade, but depreciation is something you specialize in. Kind of give us just a little bit of background, a little understanding of where you started, where you've come from, and kind of why you took to this so much and made you an expert in it.
So we're going way back.
We're going way back,
We're
Dave.
going way back.
Let's do it.
I've been doing this work since 1998. So we're recording this in 2024. So what is that, 26 years if I'm doing my math right?
Mm-hmm.
I have an engineering degree. So I got out of school not planning on working in tax. I was planning on doing bridge design, construction, etc. And I just quit my job actually because I was dating somebody who lived in a different state. And I moved out to that state, and it just so happened that Ernst & Young was hiring. And they were hiring engineers because there was this new court case that came out, Hospital Corp of America v. Commissioner. Came out in 1997. The IRS acquiesced to it in 99, which allowed for cost segregation studies to really explode. So Ernst & Young was looking for people to get involved that understood how buildings were put together. So they were hiring some engineers. I got involved in it. Went from Ernst & Young to PricewaterhouseCoopers, worked there for a few years, and then in 2007 is when we started McGuire Sponsel.
Mm-hmm.
If you went back 26 years ago and said, do you think you'll be doing this in 26 years? I would have said probably not, but it's something that I've built my career off of. And my dad always said, be good at something. When you do it, be the best at it. And so we try to be the best at everything we do.
Yeah. No, Dave, I tell you what, it's been fun to learn from you. You've obviously taught me a lot. I'm not from a accounting background either, but some of the things I've learned from you is I would say things that if I went back 10 years ago, I never thought I would be interested in. But you've done a really good job of kind of bringing us all up to speed and keeping us all in the loop and updated on tax laws. I know, during COVID, cranking in the basement, kind of just going through stuff, making sure you're consistently updating our CPA relationships and connections. I think you've done a fantastic job, so I appreciate everything you've done for us. But we're going to talk a little bit about real estate today, current situation of real estate. But I think most CPAs, especially the young ones that have got into accounting over the last 5, 6, 7 years, everything's pre-COVID, post-COVID. So let's start a little bit pre-COVID. Let's talk about real estate prior to COVID, kind of how things were moving, where we sat with bonus, because 2017 was obviously when I started. Bonus was kind of that thing that was just getting ready to come back, right? We didn't really have bonus in early 2017, gets kicked in. Talk about all that and kind of how real estate looked prior to COVID.
Yeah. So there's how real estate looked, and then there's how the tax law looked. And we'll kind of cover both. So, if you look, I've been doing this, like I said, 26 years. So I've seen multiple different real estate trends. We saw the buildup in the early 2000s, and then we saw the crash of 2007.
Mm-hmm.
So we saw where there were changes in real estate back then. Now, that affected different industries different. Now we're seeing the change, the pre-COVID and post-COVID, where there's that buildup again. Then with the COVID change, obviously, that's changing where people are in the marketplace, and that's changing things. So we'll concentrate more on that post-COVID, pre-post-COVID, and not really worry about the early 2000s because that gets a little dated.
Yeah.
But if we're just talking about real estate trends in general, prior to COVID, we saw a lot of investment. And what were we seeing? We saw historically low interest rates. We saw a lot of money coming into capital markets where people just assumed real estate is a secure investment. It's always going to go up in value. Prior to COVID hitting, people didn't really worry about necessarily what type of real estate they were investing in, where it was, other fundamentals. And the understanding was, you throw money in this, it's going to make money, and I'm going to flip it in a few years.
Mm-hmm.
So you look at big downtown areas. You were seeing a lot of people investing in office buildings, just expecting, I can buy this office building, hold it for 5 years, get a really low interest rate, maybe put some money into it, fix it up, increase the rents, and somebody's going to come buy it from me. Well, what happened during COVID is a lot of people started moving out of those office buildings. So the value of those rents is not as high anymore. At the same time, we're seeing increases in interest rates. So you're seeing empty office buildings where people were buying not for cash flow, but they were buying for that short-term investment. They can't fill them up. Now all of a sudden those loans are coming due, but at the same time, the interest rates on those loans is increasing. So we're seeing transitions in some of those areas. However, at the same time during COVID, we saw a change in the real estate market where people are more concerned about moving into certain types of housing. So housing became a struggle because we slowed down in housing developments after the 2007 recession. So there are parts of the country where there's still fundamentally too little housing.
Yeah.
So apartment complexes have grown since then. So we've seen changes where maybe the office space has been hurt, but housing has gone up. Same thing has happened on retail, where we have that traditional retail. You go back prior to COVID, and you would hear about, I've got kids ranging from teenage to early mid-20s. And prior to COVID, you might hear about them going out shopping at the mall and walking around. Post-COVID, they go, well, I'm just bought a whole bunch of stuff off an online retailer and it's going to be delivered to the house. So we see that change where the desire of people to go just hang out at a shopping mall might have changed. So the value of the shopping malls have changed. But the requirement and the expectation that Amazon's going to deliver something to your house in 24 hours has changed the desire of the retail location. So now we're seeing that move from the retail location to industrial space. So it's not necessarily that real estate has changed in value, but where the value is in real estate has transitioned. So we're seeing a move from that city center office space to areas where maybe it's residential property, maybe it's suburban office space, other things. At the same time, we're seeing similar things on retail, where we're seeing the change from the retail market to the industrial space.
Yeah.
So it's a different change than we've seen in times past. It's different than in 2007, where there was just a fundamental drop in values of residential real estate, which then trickled into other levels of the economy.
Yeah.
This is more of a transition.
What about pre-COVID transactions to post-COVID transactions? I feel like, we've talked about this a little bit. I think transactions are obviously seem like they're down right now. I'm sure you're going to give me a number. I'm really going to test your brain here, but let's go pre-COVID and talk transactions. Obviously, interest rates being low, seems like it was booming a little bit, right?
There's a question of how much of it is truly pre-COVID, post-COVID. It has more to do with interest rates. Now, whether or not, we're not going to get into economic policy and how much interest rates affect inflation and other things, but obviously the Fed's been trying to get inflation under control for a couple of years. So they've been pulling interest rates up. Well, what happens with that is that changes transaction. And so we're seeing that there's a slowing of transactions. So we can talk about pre-COVID or post-COVID, but we can also take COVID out of the equation.
I agree.
And just talk about the real estate boom that we were seeing a couple of years ago to a flattening a little bit. And it's not necessarily that right now we're at lows. What we are is we're just not at the highs we were a few years ago. So what we were seeing a few years ago is we saw historically high transaction levels. They were off the charts in a lot of areas, and that included office buildings, that included residential. It's kind of a you build it, they will come type mentality. And it changed the fundamental landscape. So it used to be that you would buy real estate with an idea you were going to hold it, maybe flip it in a few years, but you were going to generate some cash flow on it, other things. A lot of investment groups changed over that time frame, and their expectation was price is always going to increase, so I just have to hold it a few years. So we saw these transactions really accelerating for a few years. That slowed down with the interest rates going up. Now, it's not necessarily for good. There's a lot of people sitting there with money on the sidelines waiting for that transaction to change with the expectation it's going to increase. But we have seen a slowdown in real estate transactions, which changes a lot of things that people look at. Maybe your plan, if I bought a real estate, let's say in 2019, and my plan was, I'm going to hold this real estate for 5 years and I'm going to flip it. Well, we're seeing a slowdown in transactions in 2024. Maybe I don't want to flip it anymore. Maybe I'm sitting there going, you know what? The market's not where I wanted it to be right now. So what I'm going to do is I'm going to change my plan on this, and I'm going to hold this real estate. I'm going to hold it maybe for an extra 2 to 3 years. So we've got to look at how that might affect people's tax planning and other things as they move forward.
Yeah. All right, Dave, let's take a case study situation, right? And let's just talk hypothetically. Okay, someone acquired a high-rise in a big city, 20 2020, looked like they were going to try to, put some money into it, flip it. And then in 2023, they decided it was time to sell. Maybe took a haircut, maybe didn't.
Yeah.
Walk me through that a little bit.
Well, sometimes what we're seeing, and we've seen a number of examples like this. We have talked to CPA firms that see it. And you can't go into any downtown office market without seeing one or two of these, where you walk in and you see a high-rise building. It was acquired in 2019. Let's just say you got a high-rise building that was acquired in 2019 for $30 million. Mm-hmm. An investment group comes in and says, we're going to put $15 million into that building, increase rents. And let's say one of their major tenants is a CPA firm or a law firm or somewhere where a large portion of their professionals have gone virtual. And now that they get into a renewal period, and instead of increasing rents, they just have people starting to walk away from their leases and say, I'm not going to renew at the end of my lease term.
Yeah.
Now they bought the building, they renovated it, and now they're sitting and their loans are coming due. And they can't flip the building for that increase, so they can't even pay off their loans. Some of the times they're walking away from it, and the bank's taking it back. Other times they're taking a haircut on it, and the investors are. But there are times where we're seeing that building that's bought for $20 million, where they're saying they're going to put $15 million in renovations, and it's selling less than the original purchase price.
Wow.
Now, creates a couple opportunities. Now, what we see there is you got a loss position, so it's not good for the current investors, but somebody might come in and buy it, plan on holding on to it and doing something with it in the future. We're seeing questions about commercial to residential changes, where somebody wants to take an office building, convert it to residential. Probably don't want to get into the engineering issues that go along with that, because it's not always as easy as people think.
Yeah. Well, we're seeing malls being turned into residential.
We're seeing a lot of areas.
Yeah.
I mean, you look back. I know when I was growing up, you used to watch on the TV and you'd see this loft apartment style, and that was always the goal, was to be in one of these industrial to residential conversions. You're seeing some of that again, because it's areas where we see the lowest rents on an office building area, where there's the highest vacancy on office, tend to be actually in urban areas where the residential market is hottest. Mm-hmm. So you don't see empty office buildings in the suburbs where people don't want apartments. Where you see empty office buildings is downtown. Well, what do you see in a lot of those downtown areas? Think about New York. Think about Chicago. There's still a lot of people that want to live in those downtown areas. So that's why people are thinking about these residential conversions.
Yeah.
That creates some tax opportunities. You asked about bonus earlier. There's tax planning that goes into that. The key thing is anytime there's change, there's opportunities for tax planning.
Yeah.
If there's a reduction in value, that could create property tax consulting opportunities. You have a building that was an office building where somebody wants to convert it to residential. There's cost segregation opportunities or depreciation planning. You have somebody that is changing the way they hold a building. So they were planning on flipping it every 3 years. Well, now they can't flip it, so they're going to hold it for 10 years.
Okay.
Now you've got a planning where you can go in and you don't have to worry about recapture on sale, so you can do depreciation planning on it. So the key thing is anytime there's a dynamic change in the marketplace, it creates opportunities. And what you don't want to do is be the person that sits there and goes, sky's falling, interest rates are high, everything's happening around me. You want to be the person that goes, things are changing around me. How do I access the opportunities to create something?
Agree.
There was that old adage, and we saw it a lot in the 2007, 2008 recession, where money's made in recessions, not in times of growth. Now, everybody makes money when the market's doing well, but when there are changes, when there's upsets in the marketplace, that's when you see the millionaires and billionaires being grown.
Oh, yeah.
That's the time where you can buy low and sell high. If everything's just going up every day, it's really hard to buy low. So that right now is where there's opportunities, which is why planning becomes more important.
Yeah.
Because if I'm sitting there and I've got an opportunity, I want to have cash in my pocket to access that opportunity, which is where the planning techniques come in.
Well, speaking of opportunities, let's shift gears a little bit, okay? And let's talk opportunity zones. I know this is something that early on, this was a lot of fun for you. I think you were on a call probably daily, 45 minutes to an hour, just talking about opportunity zones with clients and with current relationships. Explain what happened there, what they were looking to do with opportunity zones, and how people have utilized those.
Yeah. Opportunity zones was a way to try to revitalize some historically downtrodden areas economically. Now, there's a lot of question marks about how it was implemented. A lot of the requirements for it, this was part of the Tax Cuts and Jobs Act, and one of actually the more bipartisan parts of it, where there was an idea that this would push money into historically distressed communities. And the idea is you go and invest. So let's say, Tim, you want to go invest in a downtrodden area of Indianapolis where we live. They created tax benefits for you doing that. Now, not everybody could go get them. What the opportunity zones did is they said, if you have gains, you can invest those gains in a downtrodden area. You get some deferral of the tax you would owe on that gain and potentially some forgiveness of it. Then if you hold the asset for 10 years, you get to step up the basis to fair market value.
Yeah.
So that's a lot of words, but doesn't tell you a whole lot. But let's explain it in actual math because it makes more sense. So let's say you have $2 million worth of gains, and let's say your capital gain rate, 20%.
Okay.
So you hold the asset for 5 years before a key date's coming up in 2026. But so you hold it for 5 years. You get 10% of your gain forgiven. So you're sitting there and you go, okay, I had $2 million in gain. That would be $400,000 in tax at my 20% rate. Then what happens is that gain does come due at some point, which is coming up. That's that 2026 that we don't want to think about, but is going to occur.
Uh-huh.
So you get 10% forgiven because you held it for 5 years before that date. So now you have to pay tax on 90% of that $2 million. So $1.8 million, assuming your gain rate is still 20%, now all of a sudden you pay tax. Instead of paying $400,000 in tax you would have had to pay 5 years ago, you pay $360,000 in tax.
Okay.
You use that to invest in an opportunity zone. So you use that to invest in a building, renovated the building, everything else. 10 years go by. So let's say we're now in 2027. That $2 million gain that you had, you invested in a building, you renovated, you sell that building for $10 million. What happens is you step up your basis to the value of that upon sale. So you step that up to $10 million, and you don't owe capital gains upon sale. So it's a great way for you to make money long term and not have to pay tax on it. The problem is two things. Number one, it was a short-term window and it hasn't been extended. So there's a question of, do they do another round of it? The other problem is, initially you're just deferring your gain till that 2026 date I mentioned, and then you have to pay it. So you don't have the ability to hold it for 5 years and get that 10% forgiveness anymore. So what's going to end up happening is if you did it today, you're going to have to pay capital gains rates in just a little while, in just a couple years. Well, the problem being is that your capital gain rate might change. So if your capital gain rate changes, you might actually owe more on that first round of capital gain. If you don't see that 10-year window, honestly, the opportunity zone's not that great.
Okay.
Because if, in general, you're only deferring your initial gain for a little bit. And then what you need to do is you need to hold it for 10 years to get that big thing. And if your asset's not growing in value, you got another problem. So we see there's a lot of opportunity in it, but that's one of the fundamental issues is, number one, only people with gain can invest in it.
Yeah.
So if you're trying to invest in downtrodden communities, one of the problems is people that live there that don't have a lot of gain can't do it. Only the big investment groups that are coming in. So it does have a habit of making the people that have money to invest get more money out of it, but the people that have less don't really gain from it. But the other problem that we see with it is this short-term window, is that it's really dying off right now. There's not really a benefit to it right now. And that tax liability that's coming up in a couple of years is really sitting there and starting to weigh on people's minds because they're going, well, wait a second, I invested in this building. Interest rates are higher. My building might have dropped in value. Now I'm going to owe gain on it. I can't get out of it. I'm locked in. So there are some fundamental issues with opportunity zones that we're dealing with right now. They are great tax planning opportunities for the people that worked on it. For the people that haven't done cost seg studies, for example, cost seg studies on opportunity zones are great because you get that recapture of any depreciation you've taken. Yep. But it is important that people fundamentally understand it's not a tax credit where people are just giving you money to invest in these areas. you have to have some certain fundamental areas to actually invest in.
Gotcha. Okay. Let's talk about current tax implications.
Mm-hmm.
What's some of the stuff you're seeing the most for cash flow, whether it's credits or grants? Talk to me about some of the things that we're I would say a lot of it, and we can go into IRA. We're hearing a lot from there. A lot of the energy credits we're hearing about, but maybe you could dive in a little bit more for us for the audience to understand kind of what's some ways they can get some extra cash flow right now.
Well, one of the big ways is you want to be looking at maximizing every dollar you have right now. The big thing is whether you're voting Republican, you're voting Democrat, we're sitting here in 2024, and it is an election year. And we will see taxes as a big issue for whoever wins this next presidential cycle, whoever's Congress, however the Senate's made up, et cetera. And the reason being is the TCJA had a lot of expiring provisions, including the individual tax rates that were put in under the TCJA. Corporate tax rate at 21%, that was made permanent, but that individual tax cut that you got, that's going away.
Yeah.
So it's going to come up no matter who becomes president. Now, what happens in these transitional years is sometimes people sit there and they go, I'm going to hold on to my deductions and see what happens. It's typically a bad idea, especially when you've got increasing interest rates.
We see it every election.
And and let's give an example. If I'm sitting there with $1 million worth of deductions, and right now let's say I'm at a 30% tax rate, and I'm sitting there, so $1 million, 30% tax rate, it's going to save me $300,000 on my taxes. And I sit here and I go, wait a second, I'm worried that if Biden gets elected, my tax rate might go up by 5% to 35%. So that $1 million today is worth $300,000, might be worth $350,000 in a couple of years. But number one, we have to wait till that timing works.
Sure.
So I might have to be sitting on my money for 2, 3, 4 years before that actually plays out. Number two, I don't know what that does to the rest of the economy. If the economy changes, now I might not have $1 million worth of income to offset with that $1 million deduction. So it's typically a bad idea to hold on to it. That's compounded right now because right now we've got high interest rates. We've got potentially, as we were discussing earlier in the podcast, there's changes in the real estate market where there might be opportunities to buy. So right now is typically a good time to have cash in your pocket, either to create hedges against inflation, against interest rates, et cetera, or to go out and access opportunities.
Right.
So right now is actually a great time if you have the ability to maximize deductions on your return, either through cost segregation studies, looking at moving around depreciation, creating some of those planning opportunities. Reducing your taxable income today is typically a good idea.
Yeah.
So that's one. You also asked about other opportunities that are in the market. Well, one of the big things that we saw under the Biden administration is a couple of years ago, we had this thing called the IRA, or Inflation Reduction Act. That's created a lot of opportunities for other tax credits out there. So if you're driving around, whoever's listening to this, it's a podcast, maybe they're driving around in their car, look around and look at the solar panels you see going up.
Yeah, you see them everywhere now.
If you drive through Michigan, I was driving through Michigan a couple weeks ago with one of our other colleagues, and I counted on a 1 hour drive 6 different solar companies that were putting up solar panels. Now, why is that? Well, the IRA had all these tax credits and grants in there for solar, where it might be, there's some companies that are putting in these solar panels and they're cash flowing them before they even start generating electricity because of maybe they're getting a REAP grant on it. They're getting tax credits on it. Maybe they're getting bonus credits for putting it in an energy community.
Yeah.
They're using domestic content. So it's important to understand where those things are. Try to be as bipartisan as possible in here. Whether you agree with it or not, if somebody's sitting there and saying, here's a business opportunity for you, you have to look at, does the business opportunity look fundamental? Don't worry about whether you agree with it on a policy level or not. You just have to sit there and look at it. And right now, if you have a business, you can put solar panels on your roof. In most states, it's going to be beneficial, which is why you see this huge growth in it right now.
Well, there's a local roofing company it's a large roofing company here in Indiana. And I just noticed one of their vehicles the other day, instead of their name roofing, it was their name solar. Mm-hmm. So, I mean, they're jumping in. And, of course, it was in a Tesla. So they have all pickup trucks, and the one solar is Tesla, right? So so there are definitely a lot of companies jumping into that game, for sure.
And it's important for businesses to understand what these things look at, because the problem is anytime there's also stuff like that is people are getting bad advice. They're hearing, oh, wait, if you do this, your solar credit goes up. Or if you replace you mentioned roofing companies. If you replace your roof when you put solar panels on, you can take the roof as part of the credit.
Right.
You got to be very careful with a lot of that stuff. And that's why you need people that understand the tax implications, but also the engineering side of all these to make sure that you can actually access the credits and that the credits you access are good. And I'll give you a couple examples of that.
Give me a couple of the tax codes.
Yeah.
Don't dive into the tax codes. Just give me the number.
I'm going to do you one better. I'm not even going to give you the tax code. I'm going to give you two examples of where we've seen people in practicality have issues with putting solar panels on without talking to people beforehand.
Yep. Okay.
So one example is we had a client call us. They put solar panels on. They said, this is great. Put $150,000 worth of solar energy on. I get this credit. And they're expecting a tax credit. In their case, they were looking at a 40% credit because they were in a right energy community. So they're thinking they're getting a $60,000 tax credit on this $150,000 worth of solar panels. We start looking at it, and we realize the $150,000 included a $75,000 roof replacement.
Oh.
The roof replacement did not qualify for the tax credit. Solar panels did. So all of a sudden, their tax credit just dropped in half. Not only that, the roof was then capital. They had to capitalize the roof. Now, we were able to get them some depreciation deductions by writing off the old roof and everything else, but it was nowhere near what they thought. So when they went out and they made this capital expenditure expecting to get $60,000 back and then get a bonus depreciation deduction on $120,000, and we come in and go, well, it's really $30,000 and your bonus depreciation is only $60,000.
Yeah.
That's a hit. Another example where we've seen issues because people didn't talk to their tax professional is we were talking to a company the other day, and they have put $1 million worth of solar panels on their car dealership. Once again, sounds great. They put $1 million worth of solar panels on. They're expecting this big tax credit, everything else. We talked to the CPA, and the CPA wasn't brought in till after the fact.
Of course.
The problem is they put the solar panels, as you would typically do. You have a business. You set up a real estate company and you have your business entity, right?
Yeah.
And so you go, I got my real estate company over here and I got my dealership company over here. Most of the taxable income's coming from the dealership company. But they go, solar panels go on the roof of my building. I'm going to have the real estate entity pay for the solar panels. The problem with that is the way that the real estate entity was set up, it was passive. So what that meant, all the passive credits and deductions they were getting from the solar panels were suspended over in this real estate entity. They didn't get access to them.
Oh my gosh.
That's why it's important that people talk beforehand because they're sitting there going, I put $1 million of system in. That was going to get me tax benefit, $60,000, $70,000 in year one, or sorry, $600,000 or $700,000 in year one. But because they put it in the wrong entity, all of that stuff was suspended.
Oh.
So that's why it's important that we get involved with people and we talk to them up front.
Yep.
Because that's a huge benefit, $600,000, $700,000. But if you can't use it, doesn't mean anything to your bottom line.
Oh yeah. Yeah, I think we have a lot of cases where clients have done things without consulting their CPA.
Mm-hmm.
Typically, there's a lot of money left on the table when it happens, right?
Oh, yeah.
What's the other one? They have federal grants on solar panels. I think there's a lot of companies out there that are pushing that as well. But the one thing that I've noticed is if there's any exchange of money with the client and a solar company, then the grant's off the table. Do you know much about that one?
So what I believe you're talking about is REAP grants.
Yeah.
So there's a grant program called REAP. It's Rural Energy for America program.
Okay.
Not everybody can qualify for it, but for the businesses that can, it's a great program. It's up to 50% of the cost of the system with a maximum grant of $1 million. So, but there's a couple fundamental things. Number one, you have to be in the right area.
Okay.
You have to be in a rural community, under a certain size business, et cetera. And we've got some experts that can really walk you through the details on it. I'm not that.
Yeah.
The issue is if you've already started, if you've already exchanged money in your example, it's too late to apply for that grant.
Yeah, you got to do it before.
So if you're sitting there going, I'm going to put a $2 million system on, I'm expecting $1 million grant. Well, if you've already started paying for your system, it's too late to apply for the grant.
Mm-hmm.
So that can fundamentally change the aspects of it. The other thing we see people messing up on this grant all the time, they don't take into consideration that the grant itself is taxable. So you're going to get a 1099 on the monies received. Now, it's still beneficial. I get $1 million grant. Let's say I'm at a 30% tax rate. I got to pay tax on it, but I'm still getting $700,000 in my pocket. It's important, though, that people are including that in their modeling of these. When you're talking about tax benefits being one of the drivers of these solar systems, everything else, It's important to understand how all that works. And so that's why we often say it's important to talk through these things before you get started to make sure you don't just get that trip up that maybe I wrote a check at the wrong time and it didn't qualify. Or maybe I started the construction at the wrong time. Like I said, you put it in the wrong entity.
Is it on the roof? Is it on the ground? Right?
Correct. Yeah, all those things can make huge differences.
Well, Dave, before we wrap this up, is there anything that you think we missed today that any real estate professionals, tax professionals could really take from today's episode?
I mean, the big thing that you want to be looking at today is you don't want to be leaving any stone unturned, especially right now where you've got high interest rates, you still have inflation. Now, it's getting a little bit better, but it's still higher than we would like. You've got potential changes in both the government and also the real estate industry. Anytime there's fundamental change like that, there's opportunities. Well, in order to access opportunities, you need money.
Yeah.
So that's why right now, more than ever before, you don't want to be leaving any stone unturned. If you've got a potential to maximize some deductions on an old return and catch up some depreciation, lower your tax rate, put some cash in your pocket so you can go out and make an investment, great time to do it. You can lower your property tax bill so you don't have to pay the same amount as a statutory amount moving forward. It's a great time to do it because if I can put money in my pocket and there is a change in the real estate market, now I have the ability to go after that. So I would say probably in 2024 more than ever, it's critical that people are not leaving any stone unturned when looking at planning opportunities.
As always, Dave, it's a pleasure. I appreciate learning from you. I'm sure our listeners are going to have a great time with this episode. So thank you so much. Look forward to future conversations with you. Thanks for tuning in today. Remember to subscribe to @Let's Talk Tax podcast channel on YouTube to be notified and receive all new episodes. In addition, we invite you to visit us online at McGuireSponsel.com/Let's Talk Tax podcast to see today's show notes, technical resources, and link to more about today's content.